The markets are not going backwards. For more on that, I want to bring in Jim Smigiel, SEI Chief Investment Officer. Jim, nice to see you. Jared just showed us all that green, led by the NASDAQ up more than 2%. What do you make of it?
It's a nice little relief rally here, I guess. Nice little bounce. So yeah, very interesting. Not, great news. No headline really to attach, any spark to. Microsoft not exactly instilling confidence. The OPEC news from earlier this morning is really nothing to make of it, really shrugging your shoulders at that, with oil up on the day, commodities broadly up on the day, as we've already mentioned. So yeah, this is just one of those days. It's just a little bit of a relief rally. These growthier names really coming back. I mean, these are names that are down 15, 17, 20 plus percent on the year. And, every dog has its day, and today is not that they're all dogs, but, they're having their day today.
Jim, we got some comments from Fed Vice Chair Lael Brainerd earlier today. She was on an interview on CNBC, and she said, quote, "It's very hard to see the case for the Fed to be pausing rate hikes come the fall." Is this something that, do you agree with that? And I guess how is the market prepared, or will the market potentially sell off if we don't see the Fed slow down their rate hikes?
Yeah, it's really interesting. It's a great point. I think the market has been starting to internalize the fact that, maybe we won't be on this, rocket trajectory higher on Fed funds. I agree with Brainerd's comments today. Inflation is just simply running too hot. The Fed is way too far behind the curve to even think about a pause that refreshes, if you will, at this stage of the game. We're going to see 50 in June. We're going to see 50 at the next meeting. Perhaps then we can talk a little bit about maybe downshifting to 25, just to let the 50s and let this front end load of Fed moves kind of make its way into the economy. I wouldn't be surprised if maybe we saw that, but an outright pause, the Fed is just too far behind. There's no way that they can do that at this stage of the game. They have a lot of ground to make up, and a few 50s, maybe with some 25s thereafter is on the horizon, but no pause coming this year from the Fed, not from our perspective.
Jim, Brainerd followed that up by saying the economy has a lot of momentum. Do you agree with that assessment, and where so do we see that momentum?
I think in many ways it's true. I would call it more of a tug of war. It's still at this stage we're in a little bit of a tug of war between this reflationary pulse. We're seeing a lot of that today with a lot of the travel names catching a very, very nice bid in the marketplace. But it's matched up against this kind of stagflationary environment. So are we gonna be able to make it through with the reflationary pulse going to propel the economy kind of forward and allow us to kind of get over the adjustment period necessary for higher prices? Or are we still going to be on this trajectory of really CPI reaching new highs from here, and the stagflationary environment is going to take hold, and we're going to see the economy roll over a bit? So, I think saying that the economy has a lot of strong momentum at this stage, I think she's a few months late on that. We certainly have it. The pulse is there. But at this stage, it's a bit more of a tug of war than it is a straight line in one direction.
Who wins that tug of war, Jim?
That is the $64,000 question for sure. We are not seeing recession this year. So we do think that there's enough of a reflationary pulse that the consumer started into this year with a balance sheet in good enough shape, and corporations as well. We had a decent earnings season, but the outlooks during this earnings season, with Microsoft being a great example of that today, is what's kind of giving us pause. So I think 2022, reflationary pulse wins out. 2023 is where we think that starts getting a lot murkier.
So then, Jim, how would you advise investors to be positioned then? Because it seems like we're still going to see gains this year, although next year, maybe investors should be a little bit more conservative.
I think that's right. And we feel a little bit like a broken record today. We are focusing not necessarily on the directionality of the market. We want investors to focus more on the rotation within the market. What do I mean by that? We like the more value-oriented names. So, we think that the weakness that we've seen in the growthier parts of the economy is going to continue. We think there are opportunities for gains to be had, particularly between now and the end of the year, in those value-type names. That's energy and financials versus the mega tech kind of names that have benefited tremendously over the last 10 years or so. So value being one, we do think that's a great reflationary play. And then, quite frankly, commodities we think are a great part of a client's portfolio. It's something we've been harping on for over a year now. Yeah. We still think, interestingly, that commodities broadly are very under-owned in investor portfolios.
Well, and Jim, Jim, just drilling down into that further, though, I guess which commodities do you find most attractive right now?
So we prefer a broad mix of commodities, something like the BCOM index. It's a great index. It's, you know, we paint it with this broad brush like commodities, but there's a lot going on underneath the hood. Precious metals are about 18% of that index. Energy is about 30% of that index. You have industrial metals, 15%. There's agricultural in there. We think there's a much better approach for an investor instead of trying to pick your spots, even with things like gold or things like oil, to take that kind of diversified view. And something like the BCOM index, a broad measure of commodities, we think is the best addition that clients can make to their portfolio right now. Get some inflation sensitivity in your portfolio.